portfolio manager at 249 Startups. This is our third panel, part of the Beyond Capital Summit, and today's panel is called Diversification of Family Capital and the Future of Family Offices. The conversation today is very timely because across Sudan, the region, especially and the diaspora, many family offices and family businesses are facing growing concentration risk, whether it's across geographies, currency, or traditional asset classes. At the same time, venture capital is increasingly being viewed as not only a play, but also as a deliberate and strategic tool for diversification. Over the years, 249 Startups has played a very important role in ecosystem building. We have sat at the intersection of family capital, venture platforms, and emerging entrepreneurs, and we've also supported over 500 startups and mobilized more than 20 million euros in capital, working closely with investors and to help build pathways for capital to be mobilized in complex and frontier markets, especially. Today's session is going to be 50 minutes. The last minutes will be Q&A. So please, anyone who has any questions, please feel free to drop them in the Q&A box, and our lovely panelists today will answer them. And without further ado, I'm very happy to introduce the panelists who bring very unique perspectives coming from family businesses, corporate venture capital, and global VC platforms. And without further ado, I would hand over the floor to Haytham, Managing Director of Haggar Group.
Hello, Razan. Good evening, everyone. My name is Haytham Elnazir. I'm the Managing Director for Haggar Group in Sudan. I've been actually in Haggar for the last 25 years. And based on the discussion today, I'm going to give you a milestone about the momentum of Haggar and the strategies that being set throughout Haggar. But now we'll go to the introduction, Razan. So I'll introduce myself, and then we can come back to the questions.
Perfect. Thank you, Haytham. Neda, please, the floor is yours.
Thank you so much, Razan. My name is Neda Shaheen. I'm Managing Director, DB Ventures. It's a corporate venture capital in Egypt. I'm passionate about corporate venture capital landscape and ecosystem in Africa, and I believe in its impact and how impactful CVC for this continent. And yeah, I'm so happy and honored to be here today. Thank you.
Thank you, Neda, for that introduction. Samir, floor is yours.
Thank you, Razan. Assalamu alaikum, everyone. My name is Samir Yousif. I'm based in New York City. I'm an investor at a firm called Insight Partners, which is a growth equity venture capital fund focused primarily on enterprise software. Within Insight Partners, I run a fund of funds focused on early stage emerging fund managers with an underrepresented founder within the US. And so currently investing out of our second vehicle there. It's good to be with you.
Thank you, Samir. And last but definitely not least, Camille, please.
Thank you, Razan. Assalamu alaikum. Karim Saeed here. Pleasure to be with you all. I have been doing venture for the last decade out of San Francisco at institutional investment platforms, looking at global opportunities. And over the last year, have been launching Haggar Capital, an investment platform focused on the continent and Middle East, early stage tech as our primary focus. As for myself, I was based in SF and then New York, and I was just joking with some of the folks on this call that now I'm just based out of an airplane, so just every 3 to 4 days and somewhere else as we're building the platform.
Thank you all for this very brief, but also very rich introductions about yourselves. Very excited for the audience to get to know more about your perspectives. To set the context for everyone in the room, especially for family offices that may be newer to venture capital, I'd like to start broadly by asking a very brief but quite broad question. Why is venture capital increasingly viewed as a strategic diversification for family offices, particularly those concentrated in a single geography or single currency like many Sudanese and regional family offices, even in Egypt. Maybe we can start with Neda, followed by Haytham and Camille. Yeah.
Okay, I want to make sure that I understood your question right, Roseanne. You're asking about why the family offices are concentrating their activities or their investment activities out of Sudanese or in Sudanese.
No, rather, why is venture capital looked at as a strategic diversification by family offices in
Yeah,
regions like
okay.
Sudan, Egypt, and others?
Yeah, I guess it's the way they look at the emerging markets and how are the opportunities could be in the emerging markets. So you can't neglect VCs can't neglect how much they can make money in the emerging market at the right time, the right places. I guess it's the game of investing in right time, right places, and also the places which is full of talents. And we can't neglect that North African countries like Egypt and also Sudan and other African countries full of talents that could be because of what's happening in the area of economy and crisis. Let's say sometimes these talents doesn't have maybe the full opportunity to raise, in the region. That's why I guess it's very important to diversify the investments between the African countries at the moment,
Perfect. Thank you. Haytham, would you like to go?
Yeah, regarding venture capital, I think it's very important for family businesses, especially like countries like ours in Sudan, where we have high risk of devaluation, and now we have war and things like that. And at the same time, if we most of the family business in Sudan, they have asset, but now the asset it's actually zero. So it's one of the things that reduce the risk and venturing in Africa, especially in Africa, because this is the continent that we know, and at the same time there is high demand for so many services. So during the discussion, we're going to discuss how we actually venture into these kind of ventures.
Great, thank you. Now, Samir and Camille, you guys both have experience whether working directly with family offices, supporting them, or raising from them. So I would also love your perspectives as why you perceive their interest in working in venture capital and why they actually see it as a strategic diversification. Camille?
Yeah, just to add on to what Razan and Haytham said, when you think about venture capital, and which is investing in early stage companies that are still private as a diversification measure, Haytham, you spoke about asset-backed businesses or on the ground real world industries, and how do you hedge against devaluation, or how do you hedge against war or other issues that impact it directly. I think the thing with venture where we see is it's an uncorrelated asset class if you are involved in it correctly. And what I mean by that is, macro factors affect, if you have a public portfolio, or if you're investing in public stock markets, or if, maybe this is not as pertinent to the region, but folks who are involved in bonds or other macro asset classes. On the alternative, when you're investing in venture capital, these companies are usually smaller, they're usually private, they don't have the same reactions to external shocks. You're building one product for a very specific group of people, and the success of that business is just determined within itself. So we see a lot of family offices and other allocators seeing this as a way to diversify their portfolio, to have a balance, right? You have the macro. As the macro goes up, your macro portfolio can go up. Venture capital offers a chance for you to make investments that are uncorrelated there, but then they have the opportunity to bring very high returns, obviously with a little bit more risk because you are going a little bit earlier, it's a little bit more unproven, it's a bit smaller. And I think we'll talk about this later, just like different ways of we've seen family offices get involved with the venture asset class and what are the right steps to take there. But I think for me, what I've learned is, hey, this is an asset class. It's a way to put our capital to work that isn't correlated with some of the other investments that we have, be it real estate, be it public portfolio, be it industrials, be it something else.
Yeah, I would agree with all of y'all's points. I think maybe building off Kamid's, maybe kind of I think I would maybe frame it as like where does also venture capital exposure sit from like a broader diversified family office portfolio. And so like kind of like as Haytham kind of alluded, right, you have your operating businesses, you may have your investments in kind of like public equities and stocks, like Kamid mentioned, maybe real estate, and then venture capital as an asset class is kind of high risk, high reward. And so, you might have 10% of your overall wealth allocated to venture capital, and that could end up returning 30%, kind of relative to the rest of your portfolio. It could also end up returning 5%, right? And so, like that, the risk adjustment for where that sits in your portfolio typically means maybe a smaller allocation. But I think within venture capital, and part of, my vantage point is in the industry is I invest into venture capital funds, like what Cameron leads essentially at Arkin, where he invests directly into companies. And I think about it from a very kind of like portfolio level view. So like, within venture capital as a fund, you want to have diversification across, 25 plus companies so that like, the expectation is maybe one or two do very, very well and they return the entire fund. For me, sitting a layer above, I want to have diversification across funds that I'm investing into. So I have different types of exposure, whether it's like regional, like what Cameron is building, kind of focused on Middle East, North Africa, or Africa more broadly. Maybe it's like sector specific, like enterprise software, vertical AI, deep tech, whatever it may be. I want to have diversification across those so that I can protect my downside, so that like if one sector is more challenged than others, or if one manager is performing not as good as others, it nets out and I still have a decent return while also giving me a lot of exposure across different categories. And so I think the story within venture capital as well is it's always has to kind of be a portfolio approach, whether you're building out, a family office, you're finally building out your initial kind of venture capital private equity exposure. I think a risk for folks is maybe becoming too concentrated too early in a few small investments that are just high risk, and leaves themselves open to those investments going to zero. And so, at least that's kind of how I also think about it in terms of like building out an initial venture capital portfolio from a family office perspective.
Thank you, guys. I think that is definitely something to take. I really love your perspectives in both, whether it's coming from Haytham and Neda, where they actually bring in the perspective of family offices, and both Samir and Kamid. I think it's quite rich, and definitely something to take away in terms of how venture capitals can actually react to shocks. Before going deeper into VC, I want to ground this conversation a little bit more in terms of real family business experience, particularly in Sudan, starting with Haytham. So as a Sudanese family business, Haggar Group has historically diversified through mergers and acquisitions, private equity, and even just generally operating businesses. At the same time, you have historically been engaged with 249 startups over the years to support entrepreneurs and this ecosystem. Can you share how those diversifications, those decisions were made, and what you prioritized in terms of control and risk, and what lessons that journey offers you and you're able to offer other family businesses today?
Okay, Razan, I'm gonna start just with a small introduction about Hajjar. Hajjar actually started in South Sudan in 1904 with agriculture, mainly growing tea, tobacco, and coffee at the time. He started in the first factory in 1934 for actually cigarette, and they moved to the north in 1964, which is Hajjar Tobacco Cigarette Factory. And the family, from the beginning, they have a milestone that they want to get out of the tobacco industry. So in 2010, I was actually 2011, we sold the tobacco industry. During that time, actually, we built other businesses, which we expanded into CSD in terms of Bizianos. We expanded to home appliances in terms of Colder, and we had the agency of Samsung. And then we expanded to telecom, mainly into VSAT, and then later on in submarine cables through ACE project. And then we expanded also into trade and other companies. So I'm going to give you just a small brief of the diverse of the companies and how we managed to actually expand the business in terms of commodities through feeders, telecommunications, through Sudasat, oil and gas, beverages, real estate. And during that time in 2022, actually the group starting to reshape itself because we've been an active investor for quite a long time, which we have legacy businesses. And the main idea at the time is actually to move to become a passive investor, which is the VC. And we started actually 2022 looking at different projects at the time. But with the war in 2023, it actually paused the momentum a little bit because at that time we needed to refocus in actually igniting some of the companies that already stopped during the war. And by changing some of the models, for example, Bizianos, we've managed to change the model from actually actual operation into a franchise model through two franchisees, and we managed now to expand into 9 countries from US to Canada, in GCC, now in Egypt, now Kenya, and we're expanding the business. We have the oil industry, and now we're expanding outside of Sudan in South Sudan and through partnership now in Saudi Arabia and Libya, hopefully beginning of the year. And the main idea at the time regarding venture capital, when we trying to expand, it's we're actually reducing risk. Like most of the speaker, they were mentioning the points regarding the devaluation and other issues that we're being facing in Sudan. And at the same time, to reduce the risk, the idea was to go for venture capital. And we had different firms that we work with, and we've actually, it's I don't want to say it's a easy job or difficult, but the thing is you need to find the right firm that you can work with, and at the same time you should have an idea which areas you want to work on. If you want to work on the telecom side, if you want to if you want to focus in technology or agro or any of these sectors. So as Hajjar, we've actually did a strategy plan last year, and our main focus was in the agro side, the telecom side, technology side. So actually, at the beginning of this year in 2025, we actually ventured into a company in Rwanda, which is the first company in terms of drones in Rwanda. They're working with Minister of Health. They're working also in terms of construction and other things. So the main idea of expanding is actually reducing our risk because with all the issues that we've been facing.
Great. Thank you so much, Haytham, for that, and also the background on Hajjar. But building on that, how do you see venture capital fitting specifically alongside more traditional tools? You've answered that, but I think to some extent, maybe if you can dive a bit deeper, how it can complement it rather than replace it or change it. I really love the experience that you brought in, but I would love if you can just dive a little bit
Actually,
deeper into that.
it complement the legacy businesses in a way or another. Why? Because when you venture into a new venture, you come with certain knowledge, certain experience. The thing is about venture capital, it gives you a sector that is moving very fast. And the main idea of venture capital, when you go into a project, you know exactly the due diligence that you need to do before making that decision and making the investment, and at the same time the exit plan. Because most of the people who go to venture capital, they look at the venture capital is actually to generate money, investing in a company, maybe a startup, maybe a company that started already profitable. And one of the criteria, if you look at the company you want to venture, is that the company is actually profitable. It has a plan. They have a strategic plan, or actually in 5 to 6 years they achieve a certain goal. So then you have to decide that you want to be out of this company in 4 years, 5 years, 6 years, or you want to continue. So the due diligence is important. And one of the main issues before investing in one of these venture is actually after the due diligence, you have to do a third party due diligence because it makes sure that you have covered all the boxes before you're making the investment.
Great. Thank you so much, Haytham. Maybe we can have some reactions on this from Neda or Samir, specifically how you guys perceive this as well. please.
Yeah, I can go ahead with that. So usually, as I will take it from the corporate venture capital perspective, which is it's like maybe the closest model for the family office, because the corporation or the big corporation in Egypt used to be a family businesses, and that's our case. So let me say that's from the corporate perspective. They never used to believe that investments or VC is something in the DNA of the company. They usually feel like okay, it's good to have a strategic arm that could be investing and active in the startup ecosystem, supporting the main business and bringing in innovation, and like the innovation of the startup, the agility of the startup ecosystem to the company. So back to the question, so that's why they usually prefer to support, to help and to work with other VCs, because they need someone to be someone like more experienced in that space to help them, to take them throughout the due diligence, how to judge the startup, how to choose the startup, and actually the future vision of that startup, because corporates maybe they are very risk averse, so they can't actually sign for the startup from the early stage of the startup life cycle. So I guess it's very important for family offices and for corporates to build their own community of VCs, and to be partnering with VCs in terms of like enhancing and educating them throughout the process and the landscape of that ecosystem. They have nothing, they don't understand how the dynamics are in that ecosystem. Samer, I'm giving you the the mic from here.
No, I appreciate it. And I agree with your points. I think like you kind of highlighted, whether a corporate or a family office, like kind of some of the incentives. I think part of it is that like external strategic support, right? It could be one from a like you want to expand into business lines, right? And you want to invest into companies that help you kind of get access to specific markets. It could be, like using the context of Haggar Group, if there's like operationally some things that you would like to implement into some of your supply chains that could make you more efficient, increase your profit margins, and you can leverage some startups as a way to kind of like understand what are those key companies, especially as it relates to maybe like AI these days. I think there could be like the strategic element of things. And I think part of the rationale for maybe investing directly into funds versus directly into companies is that, and Kamid can attest to it, finding and getting into the best companies is really, really hard. And it's like, and venture capitalists are all paid to, and are paid and rewarded by doing that, regardless of which, markets or geographies that they're in. And so a lot of times, like a new entrant to the field, like a family office that may have not invested directly into early stage startups, they may not have the right networks, they may not know how to underwrite and diligence those companies, and they also just like don't have the full landscape of like types of solutions that are available that could be useful. And so going in through a fund with like experience in the specific market, they can do that work for you. They can source, they can vet, they can select, and then you almost kind of get to some degree the cream of the crop of what they have seen and have been able to win. And then you can see how those maybe you can co-invest with them, right? If you want direct access, you can just connect with them as a potential customer, as a strategic. And so I feel like kind of going back to the family office discussion, I feel like there's like the two primary drivers I see, and I'd love to hear the other panelists' kind of perspectives on why they engage in venture broadly. I think there's the strategic element that I had just touched on, and then of course there's the financial diversification element as well, and that can kind of goes out to, again, kind of like as a part of an overall portfolio. But I don't know, Kamid, I feel like you might have some to add as well, being the VC in the room as well.
Honestly, I think you captured, I think I had like 3 points I want to hit, and you hit all of them much more articulately than I could. But just to reiterate the last 2 points from Haytham and Samir, and I think now that you also shared this, there is a strategic element, and Razan, you asked, like, why would you invest in venture capital as a supplement or as a something to augment your portfolio as opposed to a replacement. And as some of the other panelists shared, it is that engagement with early stage technology companies that you could then integrate into maybe the family business or some of the other investments that you have. It's learning about where the world is going. It's usually the technologists and the startup founders are on the forefront of understanding where technology is going, and so there is a benefit of having that knowledge base, having that technology, having that group in your realm of experts, right? There's a financial incentive of we invest in a company that can do well, but then there is also the product incentive. We're investing in a product that maybe the family business is an agriculture business, and you invest in an agri-tech business that then makes your core offering much more effective and much more efficient. Maybe it's in real estate, and now you're investing in property technology businesses that are making your construction more efficient. So you're double dipping, and you're also seeing where the market is going. And then Simon raised a really interesting, and I 100% agree. It's, when you think about why you partner with venture capital firms when you're getting involved in the venture ecosystem, it's because there are tens of thousands, if not hundreds of thousands of potential opportunities in the world. And it's impossible for any one person to have a grasp of all of it. And Haytham, as you mentioned, you have an asset, you have a business. And if you just think about a family office that has the generational business, whether it's in agriculture, and now you're diversifying into publics, and now you're doing real estate. We all have 168 hours in a week, right? It's almost impossible to be an expert in everything that we're doing. And so when you become a bit more strategic with, okay, I'm interested in venture capital, and within venture capital, I'm interested in this specific industry, or I'm interested in technology, and you work with a VC partner whose entire job, their 168 hours is only focused on early stage technology companies, right? It's almost impossible for someone who's doing 10 other things to think they're going to cover the landscape as well as the person who's just doing the one thing. And so the opportunity to invest with them, have them be your initial filter for the best opportunities, and then invest through them, but also have the opportunity to co-invest and learn from them. How do they think about screening? How do they think about diligencing? Over time, maybe developing your own playbook for how you want to have this expertise and how you want to deploy your own capital. But the way I see it is it's the equivalent of let's say Jamiat al-Khartoum, you're a top university, and you think you're going to cover every single child at kindergarten and identify who's going to be admitted 15 years later or 10 years later, as opposed to letting them go through primary school and secondary school, and then have other people who are experts at their craft mold them to the point that they are ready for you to engage with. It's just, it's too big of a landscape. And so having these filters, having these partners who are specialized, and leveraging them as you're getting your bearings, I think is the most thoughtful way of getting involved.
Thank you all for that very rich perspective. I really like how some of the things that are coming out is, one, venture capital can be used as a strategic tool to diversify risk. Also, some themes that came out, whether from this just conversation or even previous conversations, is that startups tend to be more agile, so they can react more to the markets, and that could help you manage risks to some extent. With that, I would actually really love if we can go to you, Nada, and your experience with GB Ventures, because as a CVC, you have used startups to diversify, to manage risk, and also strategically to enter markets, right? So how do you see, or why do you see that large groups choose to partner with VC funds, rather than building things in-house, and building that capacity in-house? And maybe drawing from your experience and success stories as well, that would be wonderful.
Let me tell you our story and how we did that, because at the beginning, when I came into the company, they had no idea about what's happening in that world. Okay. So they needed an introduction about the startup ecosystem, the VC ecosystem, the opportunity there. I needed to show the potential of that ecosystem. I needed to show how important this collaboration and partnership to the company and to the startups as well. I needed to highlight the win-win situation. So I started with an integration strategy based on a commercial agreement. I started to integrate startups who are strategically very aligned with the company businesses. and I started to track the progress with different angles. The first one was the financial ROIs, how they are generating revenues for these businesses through this commercial agreement. But what was really important for me, showing how strategic these startups are to the company. And we noticed something very interesting. These startups used to be like the middle ground and the parallel universe between the company itself and the end customer at some point. They were giving us insights that we never had access to, because of when you are a large corporation, when you start to be like very big, you have also a very big a bigger gap between you and your end customer. And I can see and I can tell that the startups could be a very good like middle ground between the companies and the end customer, because their size as a first thing, and second thing, their agility. They can collect data, they can be intimate with the clients, they can have like a warm relationship with these clients, they can gather a lot of insights, and they can give it to the main provider, which is the corporate. And also they can facilitate a huge part of the process through their technologies, because yeah, we are a big corporation, we have money, but sometimes we don't have the agility of the startups in managing things. So it was really important for me to highlight this. And we have discussed internally with the group. I was trying to actually discuss the option of funds of putting like funds of funds, or creating our CVC arm. But eventually we chose the CVC arm internally, and to set up the CVC arm internally because we have a very specific mandate. We want to invest strategically. But we chose to co-invest with other VCs because I wanted to educate the board members. I wanted them to follow the lead of a VC, because they had the mentality of the acquisition. They used to acquire companies, so they don't have the mentality of taking minority of the company. Or I was like, literally, I was saying, because I wanted to change this mentality, they were saying like, what is like 10%? What this like? We are not interested in 10% of the companies. And I was trying to simplify the process of, okay, you can have a 10% of a company value like 1 billion, and you can have 100% of a company doing nothing. And that's actually happened before. So it's not about the quantity that you want. So I wanted to educate them the right way. So I chose to co-invest with other VCs in terms of giving them more insights and educational journey on how the investments should be, and from the expert side. And also I was saying, okay, you saying that VC is not the DNA of the company. Okay, let's bring the experts and work together. But actually the fund of fund option wasn't rejected at all. But we see like it's not the right time to start invest with funds. We wanted to build our own portfolio. We wanted to have this journey and to learn more before starting like putting money. But I think it's very important to diversify at some point with other VCs or other GPs actually, because it's a very good source of pipeline and startups. We can neglect that, but for now, our case, let's say, it's we co-invest. We prefer co-investing, and we are happy with that. We have a lot of VCs are working with us, and we are actually enhancing the internal processes year by year. So yeah.
Amazing. Thank you so much, Neda. The floor is open for other panelists to react to that. And I think Neda actually did set the tone a little bit for us to go on to the next question as well. But happy to hear from the rest of the panelists what you guys think about that. And yeah.
Yeah, I'm happy to hop in. I think that approach makes a lot of sense. I think it's a good way to kind of like get into the increase ownership or like increase exposure to venture capital while still remaining very focused on kind of what are the company's priorities. And like I think co-invest is just a good tool. It's being able to leverage diligence and sourcing from other like investors that you trust. and still get access to those companies directly and have that direct relationship. So I think it's a good approach to kind of like expand venture exposure.
Thanks, Sumit. I believe this specific topic actually links with what we were talking about a few days ago, right? And what kind of structures, how can family offices or family businesses that are unfamiliar with early stage investing enter or begin engaging with innovation? And Neda briefly talked about co-investments, funds of funds, and internal CVCs. But from your perspective, what do you think are common pitfalls that they should be avoiding? And follow up to that is what different structures can family offices use to invest their family capital when it's a first-time investor?
Is that one for me? Okay. Yeah, no, I think it's a good question. I feel like there are a lot of pitfalls that people can run into. I think first and foremost, I think it's probably similar to a lot of other asset classes. I think you really want to educate yourself on it quite a bit and do quite a bit of research before you make commitments, because I think like one is understanding is kind of like an internal research element of like, what are your priorities? What is your risk tolerance? Where would you like to kind of grow and use like venture access from like an expansion perspective? Is it looking toward emerging markets? Is it looking towards Europe, America? Is it looking towards specific sectors that you want to expand to? And then like conduct kind of as much as you can, kind of a broader set of research on the types of managers that could kind of fit that. And honestly, like kind of building relationships from a co-invest perspective, seeing their portfolios, evaluating them, and happy to kind of dig into kind of what are best practices for evaluating as well. But I think so like after you conduct that internal search of just like strategically where does venture capital fit into a broader portfolio, I think the question then kind of goes down to like, who do you pick and how do you think about kind of building out a portfolio? Venture capital, different than maybe other asset classes, is very power law driven. Kind of in short, meaning very, very few companies within your portfolio will actually drive much of the returns. I think there's like a statistic in the US, like every year, and kind of, you know, so like 20 to 25 companies are actually the main drivers of all returns across the venture industry. And like those are the Ubers, the Airbnbs, the SpaceXs of the world. And then the rest of the companies either return a little bit of money or nothing at all. And so like because of this kind of like concentration in a very small number of companies, it also means when you're looking across a lot of venture funds, a lot of venture capital funds don't even return the money that was put into them, right? Like a small percentage will return, you know, 2 to 3x of the money, and then an even smaller, thinner percentage may give you 5x of the money. That was it. And so picking the right fund, I think, is very important, which is why having a diversified portfolio approach is also very important, even when you're going that level up across picking managers. There are funds that everybody wants to be in and are very, very hard to get into. And these are the ones, you know, y'all have heard of like Sequoia Capital, Lightspeed Venture Partners, Benchmark, Coastla. These are like kind of like tier one funds that like, as a limited partner, you're like, I'll take every dollar you can let me have, you know? And like, if you say less, I'm like, thank you, and you know, I'll take it. And then there's a much longer tail of emerging managers and smaller managers that like, I think have an outsized ability to actually drive really large returns. You just have to be able to kind of source them in different ways. And so like, I think how people source them is some of them are spin outs from these established firms that kind of hang up their own firms. So Cam is a great example of spun out of two really strong firms in Silicon Valley, now launching his own fund. There are also others that are like former founders that have really, really great networks of other founders that they can kind of back, and they understand how to underwrite them. And so like, I think the process kind of will have to require a differentiated kind of portfolio approach. You kind of touched on the point of structure, and then I'll stop talking because I think I've been talking for a minute now. I think like, generally speaking, so I have a very US centered perspective. I live in the US, I only invest into US based funds. And so like my prism may also be more narrow than other people on this call and other people that are listening and have better kind of vantage points. Most of the funds that we back are Delaware based. in the U.S. They're incorporated in the U.S. Their fund entities in the U.S. Even if they're not based there, and even if not fully investing there, there's just kind of just established case law around you as an investor being protected if any issues go down, like how to approach them. You can sue them in the U.S. And again, this is a very, very U.S. centered prism, and I don't think that's by any means like the requirement to do this well. I think it's just a version that I have of where my experience sits. I think what's more important is you want to make sure if there are any issues, you have clear paths to recoup your capital, hold the funds accountable, and to be able to have transparency in seeing the data of the funds. I think the structures, where they're domiciled, how they're set up, the governance, I think having really good lawyers is is absolutely essential. I'm going through an issue right now with a fund. Thankfully they're here and we're working through it, but there's a lot of access to engage because we understand the legal infrastructure here.
You're missing a lot of fun here in Africa, Samir.
I'll be there, please. I want to engage more with life. I look forward
Yeah,
to
you should. You're missing a lot of fun. That's too organized.
it. Yeah.
Thank you, Samir. Thank you, Nada. Kamil, I would love to hear your perspective here. Actually, I think you can bring in a lot of different and perspectives to this.
Yeah, I think for me, just to, one thing that Simon said, and I know he said a lot of great things, that for me is the most salient thing around some pitfalls that I've seen family offices engage in is investing in their own backyard and having a limited view of what the opportunity set looks like. As most of the panelists have said, venture exists, and within it there are thousands and thousands of companies. And what we've seen and what I've seen is folks who are venture curious, but they haven't done the work that Simon talked about of getting educated on the market and understanding power law and understanding portfolio construction. And what they just see is, hey, my friend invested in Uber 10 years ago and he did really well, and in tech in Silicon Valley. And so, they maybe see 10 companies and they invest in 2 or 3. But if you were to take a step back and you realize that 10 companies is 10 out of 10,000, you just invested in maybe 2 or 3 of the best 10. But in reality, that could be, the bottom of the barrel, last, 10 people you would even want to talk to, right? So what I've seen, unfortunately, is I'll meet with certain investors and they'll show me their portfolio and they'll be really excited by 1 or 2 companies. And in the back of my mind, I will, my immediate thought is, if you had only looked for another 2-3 weeks, you would have seen 5 or 10 times as many deals, and you would have seen that this is not the best opportunity for you. And so, pardon the, it's, are you solving for what is the phrase, like a local maxima or an absolute maxima, right? Maybe this is the best company that I saw on Tuesday, but it's actually the worst company that I could have seen all year. But if I only go out and look on Tuesday, I've invested in a bad company now. And so, Simon's point around really understanding that in venture, it is a higher risk and higher reward asset class, but the way you operate within it is you have to have a broad portfolio. You can't just make 1 or 2 investments and hope for the best. You can't make 5 investments and hope for the best. Usually we see people with, even the firms themselves, having anywhere from 15 to 20 to 25 portfolio companies within their one vintage. And then the LPs are investing in multiple of these venture firms. And so if you're an LP, you now have exposure to 80 or 100 individual companies, because the reality is a majority of them won't work out, and a few of them will return most of the gains, as Simon shared. And so looking at that is like, okay, if 5 out of 100, that's a 5% chance, are going to return all the capital, then if you are a family that's only investing in 5 companies, what is the chance you're going to hit any of them, right? Now you have a 5% chance out of 5, right? Or 5% chance out of 10. And so one thing that I really would advise anyone who's getting into venture as an asset class to do is, don't just, say, I want to get into tech, I want to invest in the first, whether ammak or this cousin who comes, or this person who you're introduced to on the first day or the second day or even the first month. Take some time, look at a ton of, pitch decks, look at, investment reports, look at announcements, understand, what is good, what is great, right? You wouldn't just buy a house without understanding what the rest of the block looks like, or understanding the school system, or understanding the environment around it. You don't just buy the first house you see. In venture is a much riskier thing. You don't just invest in the first company or the fifth company or the 10th company. Most good venture capitalists will see 1,000 companies a year and only invest in 2 or 3, maybe 4, right? And so if you're only seeing 10 or 20 and you're investing in 1 or 2, you're not really making the best decision with your capital. And so really pause, educate yourself, understand what is good, what is great, what is exceptional. Really work with trusted managers who can guide you on, hey, these are the 500 companies I saw last quarter. These are the top 20. These are the 5 I'm going to invest in, and this is why, right? As a family office, you have a lot of leverage that you can offer because you're an LP. Managers such as myself come to work with you, and we take the time to try to educate, to try to work with you, try to be that filter such that you can focus on the family business, on the public portfolio, on the real estate portfolio. Work with someone you trust to help you cover this sliver. Don't think you're going to cover all of it and just do yourself the disservice of investing in the first few things that you see.
Thank you so much, Kamil. You really hit the spot for the next question. But what specifically I really like, it's almost like you're explaining like layered risk, like choose the kind of risk that you're willing to take and be smart about how you take that risk. Just a quick reflection on and what came into my head when you were talking about this is a lot of families that we've actually engaged with to invest in a fund versus a startup. They think that by investing in the startup, they are de-risking as opposed to investing in a fund where they have that exposure to multiple startups, right? So I think that brings like a very unique perspective as to, depending on what you're seeking, investing in a fund might be the better option actually, right? For de-risking or diversifying your investments. But moving on to the next question, and you've briefly touched on it, what are the frameworks that family offices should use to evaluate VC fund managers? You spoke about trusting them, and how you really need to be selective about which fund you go to. What would you say are one of the main things that they should look at when choosing who they invest with?
Yeah, I can answer quickly, but I think Sumit will have a really good perspective on this because this is what, this is his bread and butter. He does this day in and day out. But what I would offer very quickly is, when you're looking at fund managers, what you're doing, you're evaluating them as investors, and you're also, evaluating them as people, as business partners. And Sumit touched on this very quickly. Is at the end of the day, this is a trusted relationship. This is a 10-year relationship. You want to believe that the person with whom you're getting to business is operating in your best interest, is not being short-sighted and benefiting themselves at your expense. At the end of the day, this should be a partnership and not something that is a power dynamic where they're taking the capital and not talking to you for 3 years and then coming back for more capital. It also shouldn't be one where, as an LP, you're overbearing and you see that the manager is just willing to do whatever you say, because that means they're willing to do whatever the next LP says and the next family office, and then they have no conviction of their own, and it leads to really bad returns. So I think very quickly, when you're meeting managers, what's their past experience? Where have they worked before? What investments have they made? How have those investments decisions been made? And then what was the output of that? If I work with Razan, there's something to be said about, hey, this is what you're saying today, but walk me through how you made the decision 5 years ago, and how thoughtful were you? And did you consider all the risks? And now we can look at the company today. How has it performed? Did the things that you hypothesized come true? Did you miss the mark? Did you undervalue it? And so there's a thing you really want to look at people's past experiences, but also their past decision-making, their past frameworks. Talk to other people in the industry. How is this person on a board? How has this person helped companies when they go well? How has this company helped companies? How has this person helped companies when things are not very, up and to the right? How have they treated their past partners? How have they treated their past investors and past family offices? So there's a lot that you can do to understand the person on a personal level, but there's a lot that you should be doing to understand them as a steward of your capital and a manager of the assets that that you're trusting them with. But Sumit, I'm sure, I've only touched the tip of the iceberg. I'm sure you have a lot more here. Not to throw the spotlight on you, but
No, I think you hit the nail on the head. I think, like, maybe kind of just to share my framework in doing this, and it essentially encompasses everything that Kamil was talking about. I think first and foremost, it's the team, right? Like, as he mentioned, you're investing for really, it's probably 15 years as a minimum, right? Because they're going to be investing the capital for 3 to 4 years, and then they're going to be managing the companies, harvesting returns, and like it just takes a long time. So not only do I need to have comfort in you as a great investor, a great business manager running the fund, I have to have a lot of confidence in the partnership. If there's more than one general partner, that y'all are going to want to work together for 10 plus years over multiple fund cycles. And you can do another fund, that's another, 12 to 15 years, and it just kind of stacks up. So I think there's like one is just understanding the strength of that partnership, and then really what makes them have a really, really strong edge in the market and finding and winning deals. Because as we've talked about like earlier, it's like the best companies are money is chasing them. They can choose what money they want. And then the question is, they choose the investors based on the value they can provide, introductions to customers, fundraising, maybe gives them credibility, maybe it gives them recruit the right talent. How can you actually win those deals consistently? And then also, how does that align with the broader investment thesis that you're focused on? There's this concept of GP thesis fit that I think is really relevant, where you're taking like kind of, okay, the GP, the general partner, where is their strengths, how do they source, where are their networks, and then what's their investment strategy? Like, it's like stage, sector, it's, are they leading or are they getting small ownership? Are they geographically focused? All of those pieces, and ultimately, you want to feel confident that the fund that you are backing is the most well equipped to invest into the strategy that they have identified. You also need to believe that that strategy can drive returns, right? Like, not every strategy can drive returns. And so, like, I think the GP thesis concept ties into how do they source, how do they add value, what's their fund strategy, and then the other big part of it, and Cameron touched on it, is their prior performance. Like when I'm doing kind of underwriting of a fund, I'd say half the time I spend is like going through their prior portfolio, and I just go line by line through every company they've invested in, and I'm like, okay, what is the outcome? Where is it sitting at today? And a lot of these are early, so they may, it might be 5 years old, 7 years old, 3 years old. So it's like, where are they today? What's their market? Do they feel like they're growing? Are they not? What was this person's role in the investment? How does that founder feel about this investor in terms of usefulness, in terms of would they take their capital again? All of those pieces, I think, tie into, I invest into emerging fund managers. So these are like fund 1, 2, 3, where their track record within that firm may not be that long. And so you have to do a lot of qualitative information. And then Cameron talked about talking to people, references. References are everything. I probably overdo references, but it's from having been burned and like, for not having asked a specific question and then realizing down the line, oh, that's actually an issue that I thought may be an issue, but was actually deeper than I thought. And so like, I think it's through trial and error, I've learned that talking to as many people, I talk to the founders they've backed, I talk to their investors, their limited partners, I talk to their co-investors, I talk to their colleagues. If their babysitters are still around, I'll talk to them. I think you want to get as good of an idea of somebody's character and their ability when making these investments. And then, I think the last thing I would add is that the different markets have different archetypes of funds that will win. Some markets, like say a biotech or life sciences, a very vertical specific expert in that space is highly prized by founders in that space. Where there are some categories, maybe like consumer, maybe even generalized enterprise software, where like you could just have a good brand name, you could just be really likable, you can just have a really good network across a variety of different industries that like is useful enough to any type of founder that like you can kind of win. And so like I think it's also the types of diligence that you do in managers may also be a little specific to what verticals and regions that you're targeting.
Thank you so much, Samir and Kamil. I think before we go on to the last question and opening the floor for Q&A, Haytham, in the beginning, you briefly spoke about that you have explored VCs and entering VCs with them. Maybe it would be really good for the audience today to also understand what kind of frameworks you guys have used when doing that analysis on which VCs to look at, right? Like, what are things that you've kind of assessed? How did you select or not select the VCs you worked with?
Okay, Razan. Yes. With regard to, we actually looked at different VC firms, and the main idea actually, when you want to invest, you need to know where you want to invest. For example, when we're looking at Africa, we selected four countries: Kenya, Tanzania, Rwanda. So our main focus in these countries were mainly in agro, in artificial intelligence, into trade. So the main idea at the time is to select the project itself. And when you look at the project and you do your due diligence, sometimes some of the due diligence doesn't work out. And if you find the right project and you do your due diligence, and you need to look, you should have your own criteria about which project to go to. And at the same time, as some of the speakers they mentioned, the intent of returns to these projects, and these projects fall within the strategy of the company itself and the plan after that in this investment. One of the good things about these investments, sometimes you come with your own experience as well that can add value to these ventures. And working with VCs, like most of the speakers they mentioned, you had the expertise already in the venture, and actually you refuel it by investing in these companies and try to push it all the way.
Great. Thank you so much, Haytham, for that. So for the last question, and this is open to all of you, what unique role do you think family offices and family capital can play in shaping early tech ecosystems? And through that, and as I mentioned earlier, today 249 Startups is ecosystem builder. So how can families also be part of that ecosystem building using VC as the vehicle to do so?
I'm happy to maybe to jump in, but I'd love to hear also from Neda and Haytham as well, given y'all have that real context. I think my only thought is in emerging markets, a lot of family-owned businesses tend to be some of the larger businesses as well. And like kind of when you think about how startup ecosystems emerge, I used to do work kind of helping to build out startup ecosystems in emerging markets. I actually did a lot of work in Egypt, Neda, so we should maybe connect afterwards. But when you think about like one, there's the early stage capital landscape. Much of the early stage capital that comes to companies typically comes from high net worth individuals, which are primarily going to be these descendants or like operators of these family businesses. So they can operate in a very individual sense of being the friends and family, pre-seed seed capital that helps goes into these companies. These companies have to sell to somebody, and they need to sell to the larger enterprises. That's where the larger customers are. That's where you can kind of scale. That's hopefully a good platform for them to go start within the country and then go regional to other countries. And so like being able to help facilitate the proof of concept, pilot, contracting, kind of commercial contracts within these enterprises, which can be really difficult for a lot of companies to navigate, especially small companies. I think that's a way to engage outside of just making those investments. And then I think obviously there's like the strategic alignment investments, right? And like how can you leverage these businesses as a way to help kind of accelerate your own growth, improve your margins, expand new product lines. And like I think all three of those are ways you can seed and invest into the startup ecosystem, but also leverage the different ways that these family-owned businesses can operate outside of just pure investment capital. Yeah, no, curious for y'all's thoughts as well.
Yeah, I guess from my perspective, we need to have this education and awareness for both sides. So family offices or corporates should have the awareness of how important is cooperating with the funds and VCs who has experience, and they should have the experience of choosing the right VCs to invest with. And also VCs and funds should have the sense of how the family offices think and what they really need in terms of investing strategically. They are not that risk averse like the VC mentality, so we need to have this perspective and put it into consideration and trying to handle the mentality and improving the mentality of the family office or the corporate. So I think it needs mutual efforts from the two ecosystems or markets. we need to fulfill the gap between the corporate and family offices and also the venture capital mentality. And I guess corporate needs, or I am biased to corporates, that's why I used to say like corporates, but it could be the family offices as well. They need to have the mentality of how important is the investments and the having the innovation closer to the company and to the business, and how essential it is right now. I think they have the FOMO. There is a FOMO happening right now for the family offices and for the companies, for the corporates, that they want to be, especially because we are living in the time of AI, and it reminds me of the internet and the booming of the technology part, and everyone wants to understand and to know and to work with AI. So the FOMO is there, and I think the only way that corporates can have access to that AI FOMO is through startups, through investments. Um, so yeah, I guess it's like connecting the two words together.
Thank you, Nada.
Kamil and Haytham, I guess you have a
Yeah, love to.
I don't have much to add beyond what Nada and Simon just said around the role of, unique role that family offices have in really pushing the ecosystem, whether it is from, convening, thoughtful folks around a table, whether it's allocating capital, whether it's introducing, portfolio companies to potential customers and partners, whether it's the acquisition and exits for these companies. I think, especially in, these accelerating economies, these emerging markets, because the family businesses are among the largest businesses, they have such a strong and unique position that they can play, because they play across different things. They're capital providers, they're customers, they're liquidity providers. In other markets, those might be three completely separate entities. In places like Sudan and in the Horn of Africa and parts of the Middle East, family offices and family businesses play all three roles. And so I think there's like an extremely important and relevant place that they have. And I think for an ecosystem to develop, they have to really be leaning in for champions of the tech space.
Thank you. Haytham would love it if we could get your
And
perspective on that as
yeah,
well.
definitely. I think the family businesses provide patient, long-term funding where VC sometimes is limited. Their involvement build credibility and trust in the startups, while families offer market insights and diaspora office connect to global network and capital as well.
And definitely Hajjar does have a big role that it has played in the past as an ecosystem builder with its work with 249 startups. Thank
Sure.
you all so much. I see that we have three questions on the Q&A, so I'll quickly ask them. And so the first question that we have is traditional businesses are dominant in Sudan and Horn of Africa. How can these transform into well-structured family holding or offices? Who would like to take that one? The experts.
Family business, it's they have to restructure themselves. First of all, if they want to have a holding company, they should form the structure that actually manage their businesses and having the holding company managing their existing network. And at the same time, the strategies of the group itself, how to expand their businesses. Like we mentioned today regarding VC or joining some of the firms to expand their businesses and expand their network, because at the end of the day, it all interconnected with each other.
Thank you, Haytham. A follow-up question is, have you seen the power law effect in the emerging markets, and should we look for maybe different exit paths other than IPOs in our region? Maybe Neda, given that you have invested in Africa region.
Yeah. So let me check the question again. seen the power of flow effect in the emerging markets, and should we look maybe different exit paths other than, yeah, for sure. Actually, I think that's why I do support and trying to uh, speak more out loudly, help more corporates to start to invest, because it's very important to have different types of venture capitals in the ecosystem. And also, I believe that it's not about being an IPO, it's about building a real business and having like a real business model. Maybe it's my favorite, but solving a real problem in the continent, growing the business itself. It's not about being a full-timer to fundraise like in a full-time basis and like taking the path of exit or being an IPO. I believe that right now, at that moment in Africa, we need more real businesses and startups and founders who are committed to the business itself. And I guess at some point, the business grow, like when you focus on the business model and the main goal behind why you have done this business and you started this business, the business will take its own path. It's not about like being an IPO at the end of the journey or to list the company, you know. It's not for every company, or it's not the I don't think that it should be a stereotype or it could fit all the startups, you know. It's not the same. So it depends on the business, it depends on the startup, it depends on the lifetime of the startup, what's really good. Because we have seen a lot of IPOs, the startup, once they have done like the IPO or they've been listed, they disappear, you know. It was like a
Mhm.
failure story. So I don't think it's a mandatory like thing
Exit
in the,
pathway.
yeah, 100%.
Great, thank you for that, Nada. And the last question is, what do you advise someone who comes from technical background in energy and wants to transition to investment side of VC and energy? Uh, the person asking this is currently based in Boston, so maybe our US-based panelist, some can take this one.
I'm happy to maybe jump in and then kind of fill in as well. I'd say one, it's first, I think you have to lean into where your strengths are in terms of kind of like converting into a venture role. So like given your kind of background in energy, I think, well, I think there's a few things. I think one, do a ton of research on VCs and great performing investments across energy. Pick a specific vertical within that. You know, it might be renewables, it might be software for oil and gas, it might, whatever it may be, and like get as deep as possible as you can, and then like follow all the key investors on Twitter, LinkedIn, podcasts, find the top companies, what are people talking about, what are the trends, and from there I think you'll start to get a perspective of who are some funds that you may want to work with. And then venture capital recruiting is a very long, slow process. And VCs are terrible managers and they're terrible recruiters. They may have a position open for like 2 years, but they're not like actively recruiting, but they're kind of recruiting. And then they're going to just come across a few people, and then one day they're going to be like, oh, I actually met 2 people that could be interesting. Let's start a recruitment process. And so like really how you get in is by having built that relationship kind of in advance. And ways to do that is, again, kind of what I mentioned about like getting really smart in the industry, connecting with key thinkers there. And then VCs like to see people that can kind of do the job before they do the job. That's why they like hiring people who've been VCs before. If you don't have that experience, I think there's ways to get deal experience. You can join angel groups that are looking at deals within verticals that you're interested in. Even if you're not making angel investments yourselves, you can like help with diligence, you can help with sourcing, you can go to demo days, you can like find companies that are interesting and start to share them with those investors that you would like to work with. To just showcase, hey, I have a good perspective on the industry, I have decent access to deal flow, this is what it would be like if I was to work with you, and kind of like backdoor your way that way into it. But I don't know, Cam, I don't know if you'd add anything or have a different perspective.
Yeah, I would agree with you fully. I think a few quotes that I've come across that just ring true is, everyone's hiring and they're not hiring, right? So the idea that, people are always no one's well, that's a lie. Some firms are actively recruiting and they have a role and they have a spec they want to fill out. But a lot of the firms, like Simon spoke about, they operate as like small businesses. It might be 4 or 5 partners, 4 or 5 investors. They're doing everything from, advertising their firm and fundraising and deploying capital and sitting on boards. They're doing a lot. And so they're not actively thinking about, okay, who should I go and bring around the table? But at the same time, when they see the right person and they see that, it's one of those, it when you see it. They may come across Nada and you're like, wow, she's so thoughtful and she's so well networked and she sent me these deals, and all of a sudden it just clicks. So they weren't actively looking for someone like Nada, but they met Nada, and now it's someone that they're considering bringing into the partnership. And so the idea being that you should, flex your network, go on coffee chats, get to know the people in the industry, even if they're not hiring, just get to know the partners and the firms that you would want to work with. So that's one. And the other is, if you talk to 10 venture capitalists, we'll probably get to, if you talk to 10 investors, you'll get 10 different stories of how they ended up in their role, right? And so there is no one path that you have to go and follow. But what they all have in common is, there's this understanding of what makes for a good investor. And so investing in venture capital, I would say there are 4 main parts of the job. It's sourcing, finding the right opportunities, having a good thesis, finding a good company, picking, you have to pick the right company, winning, you have to actually win the deal, and then supporting the company afterwards, right? You have to know where to hunt, you have to hunt the right things, you have to win them, and then you have to support them. And so a lot of the times when you're meeting, investors, they're assessing you on 1, 2, 3, or 4 of these, but it's hard for them to meet someone who doesn't, like Simon says, doesn't know the space, hasn't done their research, doesn't understand the industry. So how are you going to find the right companies? Right? Or maybe it's someone who understands this, but they've never invested. So how are you going to pick the right companies? Right? Or maybe you've never operated. So how are you going to support the companies? Right? So if you're not hitting any of these boxes, it's not a very compelling conversation for the investor. And so, as Simon spoke to, just think about what your strengths are, lean into those, and then think about what the investor or the hiring person would be looking at when they have the coffee chat, and how can you flex those muscles before you even have that conversation. And then for me, when I got into the industry about 10 or 11 years ago, all the opportunities that I was presented and all the offers that I had all came through, someone who I had met. They weren't even hiring for their own firm. They would say, hey, one of my good friends is someone who just started a firm. You should talk to them. Hey, let me refer you to this person I used to work with. Hey, I think this person might be looking for someone like you. Let me make this introduction. So a lot of the paths that you end up finding are not ones that you can predetermine. And so your best thing is just be in the flow, get to know as many people, show up, be educated, be presentable, be thoughtful, do the job before you have the job. Hey, Razan, I know you mentioned you're interested in energy transition, and I just came across these 2 companies. That's why I think they're interesting. Hey, Haytham, I know you mentioned you're interested in agriculture. I was just at this conference and I met these 3 operators that I think could be really valuable for you to connect with. And so when you start to show that value, they start to see you as like not just another person out of a sea of a million, but actually someone who's already doing something that I already have deemed valuable. And when I'm thinking about like, hey, I would love for someone who's, very connected to the ecosystem. Oh, what's that? Oh, that guy Simon has sent me 5 deals in the last 3 quarters, and they've all been interesting and they all just got done. They're going to call you. So my best advice is just, as Simon said, start doing the job before you're in the job. Network, get to know other investors. The path will open up, but it's not going to be a path that you're going to predetermine. There's no way to to end up in the end role, but you just have to put your best foot forward, and inshallah, that path will open up to you.
Inshallah. Thank you all so much for joining us. Thank you to our panelists for this thoughtful discussion, and I think what I love about this discussion, even as a moderator, all of you have similar experiences somehow that add to each other, right? Same thought process that comes in, but yet unique perspectives that are adding to what is venture capital and how do we leverage that as a vehicle in investing. I hope today's discussion was useful for our audiences. And if there are no closing remarks from our panelists and no more questions, I think we can call it a day and thank everyone, those that have it late as well. Thank you for joining us.
Yeah, I want to thank you, Razan, for bringing us all together today. Thank you so much also for moderating the panel. It was really nice meeting you all. Thank you. Have a good night.
It was great meeting y'all as well. And thank you, Razan and 249 for inviting me in this panel. I really enjoyed it.
Thank you.
Right. Thank you, Razan. Thank you, 249. Pleasure to be with you. And if anyone has any questions, or if we can be, or if I can be of further help, please do feel free to reach out. Happy to chat with anyone.
Thank you.
Thank you, Razan, and thank you everyone for a beautiful discussion. Thank you so much.
Thank you.
Bye.
Bye-bye.